Okay, so you want to own a bank. You put money in a vault, you lend it out at a higher rate than you pay for it. And the spread between those two numbers is yours forever on autopilot. It sounds like the cleanest business model ever invented. You are not selling a product that wears out. You are not managing inventory that spoils. You are just renting money to people who need it more than you do right now. That is the picture almost everyone starts with, and it is the reason owning a bank sits right next to owning real estate as a shorthand for effortless compounding wealth. And on paper, the industry looks exactly as big as that fantasy suggests. There are roughly 4,500 FDIC insured commercial banks and savings institutions operating in the United States today, holding a combined $23 to $24 trillion in assets. That is down from more than 14,000 banks in the mid-1980s, but which already tells you something about how this business actually plays out over time. But we will come back to that. In the third quarter of 2025, the industry's average net interest margin, the core spread between what a bank earns on loans and what it pays on deposits, sat at 3.34%, above its pre-pandemic average. Community banks did even better, averaging 3.73%. That is real, recurring, government-chartered money. So naturally, you assume owning a piece of this is like owning a toll booth with a printing press attached to it. But here is what is actually happening inside these institutions, once you get past the marble lobby and into the call reports. A bank is not a warehouse that stores money and skims a fee. A bank is a highly leveraged bet on the difference between how long people are willing to lend you their money and how long you have promised to lend it to someone else. People assume the product is loan. It is not. Not really. The actual product a bank sells is trust, rented out at scale. For a term mismatch nobody in the transaction actually agreed to out loud. Here is what that means in practice. A depositor puts $10,000 into a checking account and can walk in and demand it back tomorrow. The bank turns around and lends that same $10,000 out as part of a 30-year mortgage. The depositor thinks their money is sitting in a vault. It is not. It has been converted into someone else's roof, someone else's business loan, someone else's car, and it will not be liquid again for decades unless the bank sells the loan or borrows fresh money to cover the gap. This is called maturity transformation, and it is the single defining trick of banking. Borrow short, lend long, and pocket the spread. It works beautifully for years at a time. Then, occasionally, it does not work at all. And when it fails in days rather than quarters. A bank makes money through several distinct streams, stacked on top of each other, and understanding all of them matters, because relying on just one is how banks die. The first and largest is net interest income, the spread between loan yields and deposit costs described above. For a typical community bank, this makes up 65 to 75% of total revenue. The second is fee income, account maintenance fees, wire transfer fees, and overdraft charges, which alone generated an estimated $7 to $8 billion industry-wide in a recent year, even after years of regulatory pressure to shrink them. The third is interchange income, the roughly 1 to 3% cut a bank collects every time a customer swipes a debit or credit card issued by that bank, paid by the merchant's payment processor. The fourth is loan origination and servicing fees, one-time and ongoing payments collected for originating and administering a mortgage or business loan, regardless of whether the bank keeps that loan on its books or sells it off. The fifth is wealth management and trust services, fees charged as a percentage of assets under management for the private banking arm that serves wealthier customers. And the sixth, often overlooked, is the securities portfolio itself. Banks park a meaningful share of deposits in treasury bonds and mortgage-backed securities, earning yield on money that has not yet been lent out to a customer. Not all banks occupy the same tier, and the tier you are in determines almost everything else about the business. A community bank, typically under $10 billion in assets, focuses on local relationship lending, mortgages, small business loans, and deposit taking in a specific geography. And it lives or dies on personal relationship. With borrowers a loan officer actually knows. A regional bank from roughly $10 billion up into the hundreds of billions adds capital market services, larger commercial lending, and multi-state branch networks. A global systemically important bank, what regulators call a GSIB, A JP Morgan or a Citigroup operates trading desks, investment banking, and cross-border payment infrastructure, and answers to an entirely different, far heavier layer of regulation. And a de novo bank, a brand new charter built from scratch, needs somewhere between $12 and $30 million. Initial capital just to open the doors, before it has made a single loan, and typically takes 12 to 24 months to clear state and federal chartering approval. Choosing which tier to build in is not a branding decision. It is a decision about which regulatory regime and which capital burden you are volunteering for. Here is where most first-time bank investors and founders hit the wall nobody warned them about: capital requirements. A bank is legally barred from lending out everything it holds. Regulators require it to keep a cushion of its own money, not depositor money, against potential losses. Under the Basel III framework, banks must hold common equity Tier 1 capital, the purest form of loss-absorbing capital, equal to at least 4.5% of risk-weighted assets, with a well-capitalized total capital ratio typically closer to 10%. Smaller community banks can opt into a simplified community bank leverage ratio instead, generally set at 9% of total assets. That capital does not just sit there for regulatory comfort. It is capital the owners cannot deploy into new loans, which directly caps how much revenue the bank can generate. Add to this the compliance apparatus, anti-money laundering monitoring, Bank Secrecy Act reporting, fair lending audits, and stress testing. Community banks routinely report spending 8 to 10% of their total operating expenses purely on regulatory compliance, a cost structure that did not exist at this scale before the reforms following the 2008 financial crisis. There is one number that determines whether all of this actually works, and it is net interest margin, the same figure quoted at the top of this video. It is the single most important financial metric in the business because it is the entire engine. Everything else, fee income, wealth management, interchange, is seasoning. NIM is the meal. When the Federal Reserve raises rates aggressively, deposit costs can rise faster than a bank can reprice its existing fixed-rate loan, compressing that margin in real time. When rates fall too far, banks earn almost nothing on cash and short-term securities. The entire business exists inside a narrow, constantly shifting band, and a bank's leadership spends enormous energy trying to manage what is called asset liability duration, matching how long its loans are locked in against how long its funding is locked in, precisely to avoid getting caught on the wrong side of that gap. Two banks holding an identical loan book, the same size, the same geography, can produce wildly different outcomes, depending entirely on how they funded that book. One bank raised deposits through a broad base of small, sticky, low-cost checking and savings accounts from thousands of ordinary local depositors. The other grew fast by chasing large, uninsured, rate-sensitive deposits from venture capital firms and startups, all concentrated in a single industry. The first bank's funding barely moves when rates or headlines change. The second bank's funding can evaporate in a single afternoon because it was never loyal in the first place. It was parked there for yield. This is not a hypothetical. It is close to a documented cause of failure, and it explains why regulators now scrutinize deposit concentration almost as closely as loan quality. The federal government backstops all of this through FDIC deposit insurance, guaranteeing individual deposit accounts up to $250,000 per depositor, per bank. That insurance is what makes the entire maturity transformation trick survivable in normal times. Depositors do not panic and pull cash the moment they hear bad news, because their money is guaranteed regardless. But insurance has a ceiling, and above that ceiling, trust is the only thing standing between a bank and a bank run. In March 2023, Silicon Valley Bank, holding roughly $209 billion in assets, collapsed in less than 48 hours after depositors, roughly 94% of whom held balances above the insured limit, withdrew an estimated $42 billion in a single day. Once word spread on social media, Signature Bank followed within days. First Republic, holding $229 billion in assets, failed weeks later, the second largest bank failure in U.S. history, behind Washington Mutual's $307 billion collapse in 2008. None of these banks were insolvent on a slow, orderly liquidation basis. They were insolvent the instant everyone tried to leave at once. which is the defining risk of a business built on borrowing short and lending long. Here is what the good version of owning a bank looks like. You charter or acquire a well-run community bank with $800 million in assets, a loyal, geographically diverse deposit base, and disciplined underwriting. Your net interest margin runs at 3.8%, in line with the community bank average. Fee and interchange income adds another 0.9% of assets in revenue. Your efficiency ratio, the industry term for operating expenses as a share of revenue, sits at a lean 58%, comfortably under the 60% threshold considered healthy. Net income lands around 1.2% of assets, a return on equity near 13%, which on a well-capitalized bank of this size translates to roughly $9 to $11 million a year, flowing to shareholders year after year, compounding as the loan book grows. Here is the realistic version. Rates rise faster than your fixed-rate loan portfolio can reprice, and your margin compresses from 3.8% to 3.1% over 18 months. A regional commercial real estate downturn, concentrated in office properties, pushes your net charge-off rate from a comfortable 0.3% up to 1.1%, forcing you to set aside a much larger loan loss provision. That eats directly into earnings. Compliance costs rise another percentage point of operating expense after a routine examination flags gaps in your anti-money laundering program. Your efficiency ratio climbs to 68%. Return on equity, which looked like 13% 2 years earlier, falls to roughly 4 to 5%. And on the same $800 million bank, that gap between the good year and the ordinary year is worth $6 to $8 million in annual earnings, disappearing not because of a single catastrophic event, but because 3 unremarkable pressures landed in the same stretch of years. The bank does not fail in this scenario. It simply stops being the printing press everyone imagined and becomes what it actually is: a thin-margin, tightly regulated spread business that has to be defended every single quarter. That is the real difference between the banks that compound wealth for decades and the ones that quietly get acquired or occasionally collapse over a weekend. It was never really about opening a vault and letting deposits pile up. A bank was never the money sitting inside it. A bank was always the trust it borrowed, mismatched on purpose, against a promise it could only keep as long as almost nobody asked for everything back at once.